morning, everyone. Got a series of panels today, but as a format, would really welcome ongoing questions and commentaries through the various panels, so we have more of an interactive session. This first panel will address the definition of accredited investors, but more so where the accredited investor finds itself in the investment markets, how that might be changed. Certainly crowdfunding, as you know, under Title III of the Jobs Act, is trying to introduce non-accredited investors into the private securities space. So what we're going to do is explore where we were in terms of accredited investors, the size of the market, comments of what's going on back at the SEC, and redefining the accredited investor protocol. And with that being said, maybe what I can do is have each of the panelists, the illustrious panelists, introduce themselves, and we can go from there. Doug?
Thanks, Steve. My name is Doug Ellenoff. I'm a partner in New York-based law firm Ellenoff, Grossman & Scholl. Like many of the panelists up here, we've been involved in the crowdfunding movement since the initiation of the original legislation and the enactment of it into law I guess it's 3 years ago at this point. We have a worldwide crowdfunding practice, largely in Title II, although we've been very active in Title III, as much as one can be without the proposed rules. Sam, don't laugh. And hopefully, you're sympathizing, I appreciate that. And hopefully in the Reg A Plus space, we're 65 lawyers, we represent 60 public companies, we represent a nationwide footprint of broker-dealers, and we think crowdfunding in all aspects, Title II, III, and IV, are very healthy for the capital markets, particularly for entrepreneurs in this country.
And I'm not an attorney. I think the only one on the panel today, yeah. Richard Swart at UC Berkeley. I think actually Doug and I were sitting next to each other at the very first meeting at the SEC 3 years ago, so we're the old timers here. I'm an academic. I've been studying crowdfunding. I run a research program at UC Berkeley studying crowdfunding and alternative finance. I have also been an entrepreneur, had a startup, had an exit, been with a venture firm, so I've been on both sides of the table in pitches. And a lot of my work lately has been focused on, is this market actually growing? What's the potential? And I'm looking globally at how crowdfunding is evolving literally everywhere, from China to Malaysia to Ecuador to Chile. I wrote the World Bank report on the opportunity for crowdfunding in developing nations. So a lot of international focus and a lot of market growth in my research. And have a lot of contacts on the Hill and a lot of contacts in governments and hear a lot of rumors, and I'll share what I think I know as well as anyone can know what's happening in this town.
Hey, I'm Sara Hanks. I'm CEO of CrowdCheck. We provide complete disclosure, due diligence, compliance services for online alternative investment intermediaries, issuers, and investors. And although I am an attorney, CrowdCheck is not a law firm, and I just want to mention that I have been following this market for 3 years, and I have been wrong with every single prediction I have made, so don't listen to anything I say.
Brian Korn, partner Manat Phelps and Phillips in New York. I am very involved in crowdfunding and peer-to-peer lending. We represent platforms, investors, and service providers across the spectrum. Certainly Title II, Title III when it comes out, Reg A and Reg A Plus, very active in that. On the lending side as well, capital sourcing for real estate, small business, and consumer portals, and also very involved both in New York and in California. I'm based in New York, but I'm originally from California, so I get back as much as I can.
Thank you all. Just as a little background, I'm sure everyone's familiar with the term accredited investors. This dates back to the Securities Act of 1933, which was put in place as an aftermath of the crash of '29. The 33 Act, as you know, was laid out to regulate the sale and offering of securities. One of the provisions within that, I believe it was Rule 128, was a certain exemption to the higher level of regulatory filing if, in fact, those individuals, those investors of means, would participate. Up in 1982, that was when the numeric and the financial requirements, such as the net worth and income level, was actually instituted. Prior to that, and that's when they changed sort of to this alphabet soup, Regulation D. Prior to that, there was no determination of what an investor of means was. Since 1982, that level of income and net worth has not changed. Certainly that's a discussion that's been going on for quite some time, and I'd like to open up the panel to discussing the legitimacy of the accredited investor definition. Where do you think it should be, and where do you think it's going?
Well, I mean, I think one of the positive aspects of the reevaluation of the definition is to include some of the practical approaches that practitioners were taking prior to 1982, where if you were deemed to be a sophisticated party, a party with a degree or somebody who had the experience, that also went towards your level of your ability to analyze an investment and whether or not you should be able to participate in it. And consequently, I think one of the things, notwithstanding whether or not they choose to increase the numeric or financial tests, as you point out in the AI standard, adding those other components, I think, is critical so that we capture many more people who otherwise should be considered accredited for purposes of Title II.
Hey, maybe we could just go back and give some background as to where we are right now and what the state of play is. Because, as Doug said, and I totally agree, there's this movement to try and include more people in the definition. But the definition as it stands now and was set up in 1982 is $200,000 income, $300,000 with your spouse, $1 million of net worth. That the only changes that have been made to that since '82 is to take out the value of the house. So it's really sort of anything other than your primary residence. So when we look at what the SEC is doing now, because there's a lot of rumors about what they're doing and they're going to change it, and everybody's getting super excited. Now, bear in mind what I said earlier. I have been wrong for 3 years on pretty much everything now. So I just want to point out that the SEC doesn't have to do anything. We would like them to do some things, and we would like them not to do some other things, including upping the numerical limits. But what the statute required the SEC to do was to look at the definition of accredited investor. There's nothing in the statute that requires that, and the statute is Dodd-Frank, there's nothing in the statute that requires them to make a change. There's nothing in the statute that requires them to make a proposal. And when you talk to the guys at the SEC who are looking into this, what they talk about is our study. Now, here's the way rules happen with the SEC. First, there's this kind of, either there's a congressional mandate, hey, SEC, you've got to change this, or there's some kind of internal organic growth within the SEC, hey, there's a thing we should look at, we need to change this. Or there's something like the congressional mandate to, hey, look at this definition. The way rulemaking happens is usually, if it's a very big controversial issue, there's a concept release, and they just throw out, here's some things that could happen. Here's an issue. Is it an issue? You tell us, guys, who comment on this. Then there's a proposed rulemaking, and then there's an adopted rulemaking. All of that takes years. As we've seen with Regulation A+, it takes a long time to get through all of that. When you talk to the guys at the SEC who are studying this issue, they talk about their work as being a study. They're not talking about a concept release. They're not talking about proposed rules. They're talking about a study. So if I had to make one of my super wrong predictions, I would say that within the next few months, maybe by the end of the year, which is fast by SEC time, we'll see a study from the SEC, which will examine all of these things, and which will say, well, the Investor Advisory Committee said this, and the small business and small and emerging markets, small and emerging companies, I should know the name of the damn thing, I'm on it, that committee said this. We are thinking of these other things. tell us what's going on. So I think that it's too early to panic. It takes them years to do anything. And when they're not actually mandated to make a change, when they've got all of the other stuff, the stuff that Commissioner Gallagher refers to as the Dodd-Frank death march, all of the rules that Dodd-Frank made them do, why are they going to take this extra work on themselves? So I think we will see a study. And then don't call me when I'm wrong.
I think that that's right. If you look at other studies in the Jobs Act, there was a required study on something called decimalization and whether the tick size of trades should be moved from a penny increments up to 9 cents for companies that are newly public. And they had a big roundtable meeting, which was broadcast, and at least 40 people spoke. And they commissioned a study, and they went through it almost as long as the Ted Wells report on NFL football inflation. And they came to the conclusion that there was no definitive reason to increase tick size, and therefore, absent this definitive guidance, they're not going to do anything. And many people argued that if you increase tick size, market makers would be more incentivized to cover a stock because they could make a greater spread. So I think that caution will will carry the day, and I don't see them moving the size of accredited investor. We have seen comment letters that have said that there's an appeal to the current test because these are numbers that lay people know. If you increase the number and you keep adjusting it, it'd almost be like the Social Security exemption where you have to look it up every 5 minutes to see what the current level is. And the other problem with increasing the accredited investor test is that you're going to disenfranchise some investors who have the right to reinvest in some of their investments through shareholder agreements and otherwise. And if you take that away, you're really removing their ability to continue on with an investment that at least they were sophisticated enough to make 2 or 3 years ago.
Brian, isn't that still an issue? I mean, don't you still have people that are dropping below the accredited standard? So I don't know if that's different.
Yeah, I think that's right. I think the issue though is the goalposts are moving in this regard as opposed to somebody dropping below the threshold. The notion that certain professions are going to be deemed accredited, I think, is also not a great idea because, as you can see, there are lawyers of all different levels of quality, that many of whom do nothing that has anything to do with investments or securities. Same with accountants, and if you give accountants, then why not MBAs? And if you give MBAs, then why not anyone who went to college? And pretty soon it's meaningless. Remember, officers and directors of a company are accredited under the accredited test. So there's a specific carve-out for that. So it's not a problem right now with startups, for example, and not having accredited investors on their rolls. It's just a matter of the friends and family rounds.
I'm curious, with the lack of adjustment, Brian, you mentioned this, the lack of adjustment, inflationary adjustment to the 1982 standards, hasn't it really emasculated the purpose of accredited investor? If you look at as Sara mentioned, the income levels and the net worth levels of 1982, inflation adjusted, $200,000 of income probably be about $600,000 to $700,000 now. The net worth of $1 million would probably be about $2.5 to $3.5 million, and certainly that would compress the overall number of accredited investors in the states. I guess one question I would have for the panel is on the nature of accredited investors. What is it really trying to do in terms of protecting the broader investor base? Reason being is that if it's a prohibition on investing in private securities, there's other means by which an unaccredited investor can apply risk capital, whether it's in housing, whether it's in gambling, whether it's in lottery tickets. What's the purpose of the accredited investor definition and where that fits within risk mitigation of John Q. Public?
I just practically, as I understand it from platforms and maybe other folks on the panel, particularly Richard, who've studied it in detail, I don't think marginal accredited investors really participate to begin with. I think it tends to be, let's use rough numbers since I don't think there's any real accuracy to some of this stuff. There's 9 million accredited investors under the existing test, of which 15, 20%, well, I think it's less than that, it's like 7%, actually take advantage of the existing private placement rules. My guess is those are the higher end of the accredited investor community by and large, not exclusively. So I'm not sure how much is gained for the SEC purpose by changing the financial standards to begin with. I think it tends to be people who really have significant means to participate in private placement activity, practically.
Although one thing I would point out is the Angel Capital Association say that if you were to inflation adjust to the numbers that Steve had mentioned, they might lose 24 or 25% of their investors.
Yeah, they're very concerned.
I mean, also remember, if you have accredited investors investing in a Reg D transaction, if you have non-accredited investors, you have to provide them with disclosures. So this uniform standard from crowdfunding, from Reg A, from accredited Reg D offerings is that if you want access to the retail investor, you have to show your face to the SEC and you have to provide some sort of disclosure document. You have that in all three plus the public offering format. So, you know, there's a stat, I guess you're alluding to 92% of the U.S. population are in households that are not accredited. And, you know, I think there are capital sourcing opportunities that obviously could be gained from somebody whose income is just shy of that number. We had actually, ironically, a little bit of a bump in the number of accredited investors after the same-sex marriage case. Because now a same-sex married couple, they have to be married, can combine to meet the net worth test or the income test that they wouldn't have had individually. But
Ryan, I wanted to follow up with a question. You aptly discussed the exemption for business owners. You know, most of the wealth in the United States has been from private companies. Is there an inconsistency to allow a private business owner who may be unaccredited to buy as much of the company as he would like to create wealth, as opposed to someone from outside the door to participate equally?
You know, it's a good question. I think that you generally see that because it's a pragmatic exemption. These are the original investors in the company. When you first start, you generally have to offer shares or issue shares to somebody, and it shouldn't be the case that you have to find an accredited investor to own you when you're building up your business and your idea. It's similar to the broker-dealer issuer exemption that a lot of platforms use, which is that, you know, we have special place in the business. We understand what's going on better than anyone. And so if anyone is qualified to invest in this company, it's the CEO and the management team and the people who are working on a day-to-day basis. You know, it doesn't hold when you get into larger corporations, and the Supreme Court has said in cases like Ralston Purina, where, you know, if you have thousands of employees, then maybe you don't have that affinity. But I think early stage officer and director automatic accredited status makes sense for that company. And I think, you know, you also see that on the broker-dealer side, where if you're offering shares of your own company, you don't need to register and be a professional broker.
And I think there's an important point there that Brian made that I'd like to emphasize. I mean, the point of this exemption, this private placement exemption, is to permit people who do not need the protections provided by SEC registration to invest in a company. And people who don't need the protection are people who presumably, because they're accredited or sophisticated, can work out for themselves what information they need and how to get it, or because they are, as Brian says, an intrinsic part of the company, they've already got that information. They know their company best.
One of the areas of change certainly has to do with the implementation of the Jobs Act, the various titles. Maybe the panel, and Doug, maybe we can start with you, talk about the roles of Title II, Title III, and Title IV in terms of the investor landscape.
Certainly. I mean, I think part of the reason for the reevaluation, notwithstanding Dodd-Frank, of the AI definition is going back 3 years ago was the SEC's concern that we were unleashing all this private placement activity, and they wanted a lever to possibly throttle that back. So, and that's my own speculation. I don't know if there's real accuracy, and since I'm a fan of Sara's, whatever I say as well, you can discount tremendously. And we'll now step off the panel. So Title II of the Jobs Act, it allows for general solicitation of private placement issuers throughout the United States, no place else, so long as you only accept money from accredited investors who are verified to be accredited by either tax returns or third-party validation. And it's really that simple. You can now do a public-like offering of your securities, but the quid pro quo is you only take money in from accredited investors. So the SEC is allowing you to generally broadcast, email, tweet, whatever it may be. And so they're not regulating the offer, they are regulating the acceptance, and it has to be from an accredited investor. So that's Title II, and that's a private placement. It's an exemption from federal registration for the reasons that Sara mentioned. It's less sensitive activity from the SEC's point of view because you're not selling to a class of investors that they deem to be not, bless you, unable to protect themselves. That's Title II. As of September 23rd, 2013, that's permissible activity over the last 18 months. On dozens of crowdfunding platforms here in the United States. Venture opportunities and real estate opportunities in particular have been selling Title II offerings, and it's been smooth from the SEC's point of view. There have not been problems. I was there recently. I asked that specific question, and there's no conduct that's being currently conducted on those platforms that they shared with me in any case that they were particularly concerned by programmatically. Doesn't mean there won't be problems. Doesn't mean there won't be failures and lost investor capital. But on those Title II platforms, by the way, I would mention, and it's, to the extent we're making distinctions, on Title II platforms you have what are called 506C Title II general solicitations, as well as old school 506B offerings. So when you go to the site, you can't see all the deals because it's really password protected and behind the scenes of the crowdfunding platform. And each one of those platforms, by the way, has a different revenue model, whether or not they're a broker-dealer or they're doing things like an investment firm or they're a posting listing site. And you should familiarize yourself with each because each of those business models has a different legal responsibility from a fiduciary point of view as well as a due diligence point of view. That's Title II. That's what's been active under the Jobs Act since September 23rd, 2013. Reg A+, which just passed, and I'm pleased to say many of the people in the room, but particularly Sam Guzik, have spent a lot of time working on that initiative, and that will go into effect June 19th. And Sam, do you have any deals that are going live that day you want to share with us?
Well, that remains to be seen.
It remains to be seen, okay.
Like I told you, I'm kind of like the LAX air traffic controller, deals coming in and deals waiting to take off. Yeah.
But if you're interested in about more Reg A+, I'm sure we'll talk about that later. So Reg A+ it's an exempt from registration technically. It's an exemption from the public offering rules, and Sara's much better on the terms of art here than I am. But it is a review process. You have to file a registration with the SEC and have it reviewed and commented upon, and it takes time. That will allow an issuer to offer their securities to both accredited investors and unaccredited investors doing a general solicitation. And then there's a whole series of rules that go with that as well. So that is the SEC's second initiative under the Jobs Act that responds to this marketplace and raising money up to $50 million if you do audited figures. If you don't, $20 million. And with the up to $50 million, you preempt state securities laws. And then the last one, which is really my baby, is Title III, which is crowdfunding through online platforms, which Title II and Title III have to be conducted. Title III has to be done through an online platform that will currently, as written, be regulated by the SEC and FINRA, and that's up to $1 million. And that's accredited and unaccredited investors. There's disclosure requirements. There are investment caps on each of the individuals. There are a lot of investor protection provisions built in there. But as Sara mentioned earlier, even though that law was signed, it was signed into law April 5th, 2012, we sit here 3 years later. Proposed rules have been written, commented on extensively, but there doesn't seem to be any genuine momentum to make it happen, even though we get a lot of lip service that it is a high priority at the SEC. But those are the three primary provisions, as well as adding the old school 506B that issuers can take advantage of to raise money, both debt and equity, in a way that's somewhat different than what Brian does a lot of, which is marketplace peer-to-peer lending, which often is a registered securities, I think, for both Prosper and Lending Club.
The one thing that's interesting about the Jobs Act is that if you take Title I, for example, which is the IPO on-ramp, the ability to do confidential filings, test the waters meetings, exemption from Sarbanes-Oxley 404B, the rules went into effect when the president signed the bill. And the SEC went out with an FAQ a few days later and said, our systems aren't really ready for confidential filings. Send them in by paper for now, and within a few months, we'll figure it out. And it got done. And over that summer, everything worked well, and you had a fully effective Title I, which has been very successful. I don't know if companies are going public that wouldn't have otherwise, but at least it's less costly for those that qualify. Title II, Title III, Title IV all required extensive rulemaking, even though in Title III's case, you almost had the entire crowdfunding statute hardwired into the statute by Congress. And so I am waiting for some sort of contempt or other type of action that somebody in Congress can say, we put these rules out April 5th, 2012. The deadline was December 31st, 2012. We just celebrated the second anniversary of the deadline. You've had proposed rules, which have basically mirrored what was in the statute for going on 3 years now, and nothing has gotten done. And I think if there weren't a movement towards a Jobs Act 2.0, and if the market wasn't clamoring, was clamoring harder for a Title III, I'd be wondering if people in the SEC would be facing more of a wrath from Congress. I don't know if anyone has any thoughts on that.
I'll jump in on the politics. Spent a lot of time on the Hill, and what I'm hearing is that McHenry, well, I've actually seen a draft bill that he has ready to go, but having a congressman from North Carolina having a draft bill does not mean that you have a Senate sponsor, and he needs to find a Senate sponsor to get it through. They're talking to 6 or 7 different senators, so there is a drumbeat to do some sort of a legislative fix. And with the Republicans being in control, McHenry being deputy whip, he basically feels like he has some political power. It's his turn to exercise some of his political power, and he wants to take it back very much to the original crowdfunding act that went through the House. 5 million cap, much lighter weight registration requirements, removing the requirement for audited, which makes it 0 cents for a small company to require full audited statements. Now, this is sausage making. Who knows who the Senate sponsor will be? Who knows how it will emerge from committee? Who knows how it will get marked up? I mean, no one can predict it, but I'm actually surprised that the bill was not introduced in April. My bet was, again, like Sara here, we're really bad at predicting the market here. I had publicly said a couple of months ago that I think you'll see it in April, and obviously here it is in May, and we haven't seen it yet. So before the summer recess, I would be surprised if it doesn't come out. The White House has fairly clearly indicated that they don't care, meaning they're not going to put much political capital behind Title III. It's not a huge issue for them. So I think whatever Congress does will pass. I was on a call with the National Economics Council a couple of weeks ago, and their concern was, why isn't Title II having more impact? What can we do, and what's wrong with Title II? Why isn't it growing faster? So they're interested in, is there something that can be done to make Title II more effective? And Title III is like, well, we'll see what Congress does. So I don't see a lot of political will from the administration to do anything. So the question is, does the Republican Party push something through to fix it? And I'm surprised it hasn't already started.
Yeah, it's an interesting point on the whole Title II thing, because what we're seeing, I would have, if you had asked me like last year or in September of 2013, How many deals are going to get done under Title II, generally soliciting private placements? And I would have anticipated that it would be up to at least 10% of the existing angel market fairly fast. That has clearly not happened and is clearly not happening. And when you ask the question, well, why isn't this happening? Sometimes you get responses from issuers like, well, I didn't know about it, or my lawyers don't like it, or more importantly, the angels don't like it. There's a lot of angel investors out there or angel groups who are like, we don't want this generally solicited. We've got a nice little company here, and we want to look at it. We don't want to share it with everybody else. We want to keep that for ourselves. What we are seeing, though, is these hybrid offerings where a company is doing an offline angel raise and just raising a little bit on one of the platforms, so just to test the waters. So that's one of the mysteries of the whole Jobs Act is why isn't Title II a bigger market? Which leads to a sort of question that I keep asking, and forgive me for putting this in incredibly politically incorrect terms. When people talk about Title III, crowdfunding, and they say things like, this is going to be bigger than the Industrial Revolution, and this is an actual quote, or this is going to, around CrowdCheck we go, yeah, this is bigger than sliced bread, this is bigger than oxygen, this is bigger than breathing. And so when you say, there's this pent-up market demand to use Title III. Here's the politically incorrect question. Why is the market for the poor people going to be bigger than the market for the rich people?
Okay, well, I'm going to take that. I think that observation actually, and I understand why Sara says it that way. I think that's the wrong question. I don't think whether or not it's a larger market or not really matters. It's about participation is my point of view, and I know you don't really disagree with that. And my answer on Title II is, so our law firm has been at the front edge of several controversial programs over 23 years that for one reason or another are not embraced by big law, big investment banks, because they're catering to a community of people who've been left out of the process typically. And those programs typically have acronyms you can look up called SPACs and PIPEs and RDs and things like that. And they all start off as cottage industries or as outliers, just like in the Gladwell book. And over time, once people realize there's nothing inherently nefarious about those activities, they are just tools for people to use, and good people will use them properly, they grow. But the amount of nonsense and noise that conventional capital markets participants put out about the Jobs Act, because it didn't benefit them, is what we're up against. So yes, the ACA, who says that it's going to eat into 24% of their accredited investors, well, that's speaking your own position. I'm not sure that's an accurate number. So there's a lot of misunderstanding of these marketplaces that takes time to sort through. Regulators don't help that necessarily. So I believe that Title II is actually outstanding as to what it's achieved in 18 months, notwithstanding all of that establishment rhetoric and tension. So I don't know what the actual numbers, whether it's hundreds of millions of dollars, have been raised in online Title II offerings in that 18-month period. That's excellent. There's nothing wrong with that. And offline Title II, I think, is multiples of that. So it takes time. My SPAC program started 20 years ago with $10 to $20 million offerings, and now we just closed a city deal, $150 million this week. So it'll figure itself out. Title II first, because it's wealthier people, and then ultimately Title IV will have a role to play. And yes, Title III will work. It will not be the fraud that people say it's going to perpetrate on the average person. People will be able to invest in things that they know and like. And if it's just a little cottage industry that's not bothering anybody else, let it go forward. The SEC proposed rules are very conservative, very enlightened, and in my mind only need limited amount of change. So if it's not big, that doesn't mean it's bad.
Can I say something? I think Sara, excuse me, also, it's not between Title II and Title III, it's not an either or.
No.
I think that I think Title III and Title IV will help Title II.
think that's
Because
absolutely right.
I think you build this bigger ecosystem of crowdfunding and people become aware of it. You know, people are not aware of crowdfunding yet. Everyone in this room thinks it's like really cool and
Better
the
than sliced
center of
bread.
our lives. But outside, that you go down the hall and ask someone in that room what crowdfunding is, they say, I have no idea. You know, nobody knows what it is. And with the bigger market in Title III, it's all going to sell.
I think that's an excellent point, and I don't mean to say that a small market is pointless. I'm just sort of addressing the issue of one of the things we're going to have to address when Title III goes into effect. If it is a small market, which it is in the UK, I know Richard looks at the UK very deeply. On the equity side, it's very, very small. That doesn't mean that it's not the case, as Doug says, that this is a very useful tool. I don't mean to say that small is bad.
No,
I think also part of the problem with Title III and public crowdfunding generally is that there's a fear that it's going to become the financing of last resort. And if you have a very burdensome process that is the costliest form of capital raising, you're going to take a risky asset class to begin with, which are startup companies, take away those that get what we call venture finance or mainstream capital finance, take out those that get Title II crowdfunding finance, and you're left with a risky slice of a very risky asset class. And then you want to present it to the retail investor, who is the most protected form of investor we have. When I worked at Citigroup, we had committee meetings that went for hours, and we talked about suitability and retail suitability about certain transactions, even public offerings that we didn't think were suitable because of the risks involved or because of certain aspects of the business or the company. And you see that in various industries. So I think that there is the reason you have a reluctant SEC and the reason that the market is a little tepid on Title III is this, well, we can only raise $1 million. We have to get an audit. We have to go find a funding portal. We have to pay X amount of lawyer fees, file with the SEC, wait 21 days, file it, produce an offering document. It's going to cost us $100,000 to raise $1 million if we're lucky, and then we hope there's a market after all that. And so it's a very tough pill to swallow at the current levels, which is why I think a lot of people are anticipating a revamp of the rule.
Well, I mean, my response to that, again, being a Title III fan, is the assumption in there is that registered shares that then allow the public and unaccredited investors to invest through the brokers are inherently safer. And just because you have good quality disclosure doesn't mean that they're any less risky to an investor. And yes, through brokerage firms, there's a suitability review and responsibility, and the same thing holds true based on statutory limitations of how much people can put into a Title III deal that I think safeguards people from putting too much money into any given deal. And most importantly, and this is really the challenge that I have for regulators and detractors of the program, is the amount of money that friends and family, unaccredited investors put into deals every single day, not only here in the U.S., but elsewhere, is significant. That money is being lost, if you look at it that way, less responsibly because it's being done without the disclosure that we're talking about here. So to bring that into an online environment with proper disclosure can only be good. And the belief or the acknowledgement that there's a lot of expense associated with Title III, I share. I think there are things to make that a better program, but actually get the program started and the numbers will come down to suit that marketplace over time, because that's what happens in most marketplaces.
Do you think that there's an opportunity for, in the Title III funding that you're doing, to have the hosting sites themselves or the crowdfunding themselves to help out those individual companies, so for these filings and regulatory that go along with it? Because to that point, it seems like, to your point, if I'm trying to raise money for $1 million for a small company, that's where the growth will be. To produce these documents and actually have to do the filings is something they're not even thinking about.
There are people working on automation solutions for many of those issues. There are people in the room who've been
On this
on this panel as well, but conflict of interest, we won't disclose some of those things, that are going to respond to those things because that's what entrepreneurs do. And that is how this is going to end up working. And I am quite comfortable that the quality of the investment process in a Title III deal is going to be better and more satisfying for people than the detractors or investor protection advocates actually believe. Read the rules carefully, and you will see the requirements are substantial. And versus Title II, where there's no documentation requirement except to satisfy anti-fraud standards, as if somehow being an accredited investor magically, which we do in this country, makes you not have to get that information. I just disagree with that.
Hold on a sec, Joseph.
I really appreciate those comments, Doug. And Brian, I think it's important to not overlook some of Sarah's comments earlier, which were I'm happy with the percent of the market that's adopted Title II. I wish it could be more. But I think it's really worth looking at what those concerns were that we're hearing in the marketplace. You know, I'm hearing the exact same ones all the time. It's amazing how many securities attorneys stopped their learning curve when they graduated, and that the Jobs Act is only understood through a briefing paper that was written 2 years ago or a year and a half ago. And
Right.
so I think it's really worth looking at how we as an industry, since most of the folks in the room are part
I
of
have
that,
updated slides, but
directly address some of those very particular issues because
Only a
we
year
can have
old.
great platforms, we can have great attorneys that understand Title II, but at the end of the day, if the issuing company goes to their local attorney and that local attorney says no, because they don't know about it, or they go to their accountant who says no, or they go to one of the lead investors that they were hoping to get on board who says no, it's not going to happen. I think it's worth addressing those and looking at those issues in a significant, substantial way. And also how maybe we can start working now to ensure that a similar dynamic doesn't happen when we roll out Title III and the state ones.
Let me make a quick comment and then lots of questions. So I'll give you an example of the lack of awareness that we're facing. I won't pick on the state, but it's a Midwestern state. I was there recently, I was speaking, and it was like the blank state association of CPAs. And the president of this state association of CPAs turned to me at the table and said, "What exactly is crowdfunding? I didn't know you could raise money online." And this was the head of the CPA association of a large Midwestern state. So so we all assume that there's a lot of information out there, but a lot of it's garbage, and a lot of the industry reports are garbage. So there's not a lot of very reliable sources of information in the industry. There's one, I was, the lead author of the World Bank report, which talks about the $93 billion global market in equity crowdfunding. If you read the footnotes, there's a lot of assumptions in that number. One of which is that China changes their laws because it's China's 48 billion of that. So, if, those nuanced details about what I was actually saying are oftentimes lost, and people say the U.S. market will be $100 billion. That's not at all what I said, and there's tons of examples I could give you like that over this misquoting. There's one statement out there that crowdfunding will be $3.2 trillion by 2020, which is
There's
just
a lot
Bigger
of
than oxygen.
yeah, it's better than oxygen. So, to Doug's point, my friends in the Netherlands and in Europe say, well, equity crowdfunding works really well for a small percentage of companies sometimes. And why are you all so excited about it? It's not going to be a massive explosion. We're not going to have every investor wanting to pile on. It's going to be a niche opportunity for a small amount of companies, and it's going to work relatively well, and it's just part of the funding ecosystem. And why are your regulators so concerned? Because there's not going to be this, $500 trillion market or whatever obscene figure we want to pretend will exist. And it works relatively well. And the whole issue of fraud is certainly overwrought for multiple reasons. First of all, empirically, it started in Australia, then went to Europe, and I could go through the history. But if you look at the data globally, there's not been a single prosecution to date for equity crowdfunding fraud. And I think that there's just much more efficient and effective ways of committing fraud. And the criminals are finding easier ways of doing it. I'm not saying, there's a little bit of fraud in all markets, not a lot of fraud in most markets. I think the risk is significantly overblown. So I think lobby has been pushing this, grandmother's going to lose all of her money, false flag argument. essentially due to some political tension about the role of investor protection and consumer protection, the Warrenites versus the libertarians in Congress right now. I think this, in a way, has been part of that broader debate. But I think that, Title III, the rules are very explicit, and I don't think there's a lot of debate about what the rules have to look like. So let's be honest, the reason that we haven't seen Title III moving, and what I'm hearing from the staffers is, and I believe the staffers have pretty good insight, there's not a lot of momentum to do anything about it. And I think they're waiting to see what Congress is going to do. So I guess my main point is let's dial back our expectations here. It's going to work for X percentage of companies, but it's not going to change the world. It's not the revolution. It's going to change all of finance. And this argument of democratization of access to capital, the data is not supporting that whatsoever. It's still a bunch of white guys. And the exception is it does seem to be working for female business owners. Women are being successful using crowdfunding. So it may be nipping at the buds of the lack of access for females, not minorities. It's certainly not broadly distributed. It's mostly tech entrepreneurs on the coasts and existing cluster cities. So it's not happened yet. So the hope and the political aspirations of democratization are great, but the reality isn't there yet.
Before we go into additional questions, I think it might be helpful that the panel's been talking about regulations and the perspective that the SEC and others have, which in my view is very internally or myopically focused. What happens in the U.S. stays in the U.S. I'd love to get Brian Kozak, who's an acclaimed attorney up in Canada, to share a little bit what's going on in the Canadian market, how that compares and contrasts, how rapidly things happened up in Canada, just as a bit of color.
Sure, thank you. My name is Brian Kozak. I'm a partner at Castles, Brock & Blackwell in Toronto. That's a law firm. And I'm also on the Ontario Securities Commission's Exempt Market Advisory Committee for 2 years. So I have been looking at this for a while. I would really enjoy the discussion on accredited investors because this is kind of like deja vu, and it's kind of ironic because usually we follow the U.S. We just closed off our round of accredited investor discussions, and actually on May 5th, they implemented the results. So I'm listening to Sara talk about studies and the impact of the marketplace and investors. And these arguments and these debates were resonating across Canada when they're looking at changing it. The big issue was 90% of capital raised in Canada is under the accredited investor exemption. Only 4% of investors are accredited investors. So the concern is if you're going to index it, that you're just going to massively move the market in the wrong direction. And the big issue was selling to non-accredited. So the elephant in the room when you speak to regulators is, well, why are you selling to non-accredited? It's like, why aren't you verifying it? And the answer is, well, I never met you, but can you tell me how much money you make? What all your stocks are? So, they think it's an easy question to ask. And I'm really intrigued when I, see and hear about things like CrowdCheck and how they do AI verification. I think you guys can access tax returns, which you cannot in Canada. And it's really a one-on-one conversation. So our big change in terms of selling to these really rich, sophisticated, accredited investors that can fend for themselves was that they kind of look at them as retail. So the big change that's happened as of May 5th is they've now introduced, you can no longer tick the box, not that you ever could, but they now have a risk warning questionnaire that details, like, do you know that you can lose all your money and you have to initial it? Do you know that these stocks are risky? You have to initial it. So that's kind of come into play. They've made some changes to the definition of who is an accredited investor. But the big thing that a lot of issuers are concerned about in terms of non-brokered private placements is that they have to do all this verification. And none of the law firms have had these big treatises saying that this is what you have to do. So there's a disconnect thinking that this is all new when it's not new. And what I also, the discussion about Title III, Title IV is exciting, is on the crowdfunding in Canada. I'm hopeful, and I'm going to take my lead from Sara and Doug that I'm probably wrong, that I'm hopeful that they're going to come out with something on crowdfunding in the next couple of months. And unfortunately, we don't have a national regulator. We just have different provinces that each have jurisdiction constitutionally over capital raising. And under crowdfunding, our version, our proposed, we've kind of taken like certain parts of the U.S. one, like you can raise up to 1.5 million instead of 1. They no percentage of income or assets because they don't think a portal can figure that out or people will lie. So it's a $2,500, $10,000,
there was like 800 comment letters that have come out. I'm confident they're not fussing over this. So I think that they were looking for the U.S. lead. U.S. has lost steam. I'm listening to all these reasons, and it's very depressing listening to all non-exciting things happening in Title III. But I actually think Canada's going to probably move forward. Probably 6 jurisdictions like Ontario, Quebec, and 4 others are looking at it. And the general concern is they're afraid. And we talked about the unleashing is a word that's used, and everyone's going to lose their money. At the end of the day, I like the way the panel has positioned this. This is just a form of capital raising. It fits on a spectrum. Maybe it's for you, maybe it's not. And the other elephant in the room is, there's a younger generation that does everything mobile. They'll do stuff like this, but there's others that won't. So you're then going to have the whole building of trust working through.
Okay, one last question, and then we'll wrap up the panel. Yeah,
Richard, primarily for you, it seems to me as an issuer and an investor that you've got a cultural climate where FINRA is doing everything they can to reduce the number of broker-dealers. Bank regulators are killing small banks. What on earth is going to drive the SEC to open the floodgates and allow more investors to be preyed upon by criminal capitalists? I mean, it seems like we've got this cultural paradigm that would make it foolish for them to leave the accredited standard as it is and/or to make Title III easy to do. It's like they got a sort of an asymmetric payoff profile. What are you hearing politically?
Very little from the SEC. I mean, I've been in probably 5 or 10 meetings with the SEC in the last 3 years, and I always walk out wondering if it was, if they have the same playbook as the Feds, because I don't really understand what I'm being told most of the time. My guess is that the SEC is responding to this, I think, overwrought cultural phenomenon of investor protection, and there's a definite rhetoric drumbeat of private markets are inherently evil and private capital markets are just cesspools of fraud, which is just frankly overwrought. But I think it's more political tension. We have to be honest. Title II and Title IV enjoyed broad bipartisan support. They came out quickly. Title III has been massively opposed by the Democratic Party, and mostly they have been fighting tooth and nail against it. So I think a lot of it depends on what the next election cycle turns out. And seeing.
Richard, can I just say, I think the premise of the question is wrong. I think that the premise that the SEC is sort of opposed to crowdfunding or something.
Yeah, I don't think that.
The SEC has been absolutely pro-crowdfunding from my perspective. Title IV, they could have done a lot of bad things.
Oh, they did. That was great.
In Title IV. And instead, they include the wrath of the state regulators to make Title IV very workable. They've done the same thing with Title II and the Title III regulations. I think the SEC, within the statute that they were given, you can't say that they were negative for them. So I just think, when we sit in Washington, it's always easy to blame the SEC for stuff. But the SEC has actually been very accommodating to this industry so far. At least that's my perspective.
I think that's right, Mike. And I just want to jump in and give another piece of praise to the SEC for something else they're doing without being told to do it. What we've seen across the nation is a number of different states trying to introduce intrastate crowdfunding. So there is an exemption at the federal level if you comply with the rules of either 3A11 or 504, and I'll stop quoting laws to you because that's boring for you. But if you comply with the federal requirements, then the states can do whatever they like. The trouble is that those federal requirements include a few things that don't quite work in modern days. You've got the SEC now publicly saying, hey, we are looking at giving an assist to the states by taking those unworkable bits of 3A11 and 504 and making it possible for you to say, for example, go on Twitter, go on the internet, and do a general solicitation, but say, but only for Georgia residents, and let that happen. And that is something that the SEC is doing without being prompted. and they're clearly trying to work on it. So hopefully that will help, and we could see, because they can do this in-house, they don't have to have a statutory requirement, they could just write it in the next couple of weeks. Now, of course, it's the SEC, so it's going to take quite a long time for it to happen, but they're working on that, so yay them.
Okay, final question.
You got more time.
Oh, okay, okay. Richard.
Maybe get in the weeds a little bit, but my understanding is on these crowdfunding sites that most of the money is coming from 506B investors, which are people checking the box, and that they're relying on not a prior, really what I consider a strange way to define a prior relationship, which is 21-day, hey, come on the website, sign up, and 21 days later I have a prior relationship. And so talk about that a little bit, and also how if you do a C, you can't have B investors, if you do a B, you can't have C investors.
Yes. Do you want me to?
You want to do it, Brian?
Sure. So the question you're really asking is seasoning. There's a seasoning requirement on several websites where you have 20 days, 30 days. This is actually a misunderstanding of an old no action letter called LAMP Technologies. Reg D is a safe harbor under old 4.2, which is now 4A2, which is the private placement exemption, which you can do a one-off private placement if you're a company. The advantage of going through Reg D is that you have a safe harbor, and if you're issuing to more than 2 or 3 individuals or 2 or 3 people, using Reg D is the preferred approach because you know that you can issue, for example, under 506 to an unlimited number of accreds. Under the old no action letter, if you didn't have a previous relationship with an investor, you were required to build one. You were also required to charge them a subscription fee and other services, which nobody does. And so people are complying with this seasoning requirement, thinking that that's going to help evidence their relationship, but they're not charging them the seasoning fee or the subscription fees, which are required under the no action letter if they're really going to follow the letter. So I've been advising clients that they actually don't need to have any kind of period if they're really going to be under the safe harbor of 506. And most 506 transactions take place where many of the investors did not have a prior relationship with the investor. It's interesting, where we get a lot of guidance on what's the difference between solicitation and non-solicitation comes from an enforcement case last year called Eureka, which was a Cayman Islands-based platform that did a few bad things. The first thing they did is they started soliciting before the effective date of Title II, so that was a clear violation of the rules. I was not their counsel.
Sarah was.
And but if you read through the enforcement language, they actually lay out the criteria that if you have a transaction that is on your homepage, that's a live deal, that's investable, it's not behind a password wall that you're soliciting, and if you're sending out blast emails to people who have not consented to those emails, that's also a hallmark of solicitation. And so you can have solicited offerings and non-solicited offerings, but logic dictates once you solicit an offering, it can't go back to the non-solicited box. So if you do a solicitation, then everyone who invests in that transaction has to be an accredited investor, and you have to have enhanced verification procedures. If you're doing a non-solicited transaction, you can have a non-solicited platform that still has a homepage that says, invest millions in the market. You can have past transactions, fully funded deals, case studies, examples. You can have a video that shows how it all works. All that's fine. That's not considered advertising. As long as you don't have a live deal that's ready to be funded on the homepage without requiring anyone to sign in, my reading of the Eureka enforcement case is that you're not considered soliciting. And so a lot of platforms have said, we just want to make life easier. We're either going to solicit everyone in and verify, or we're not going to solicit and not verify. But you can have elements of both in your website.
Well, Kim, okay.
I wanted to go back to Title III and the comment that it doesn't have the potential to be transformative. And I would disagree kind of with that statement, and here's why. As the former CEO of a community bank, I see there's huge potential for business owners and entrepreneurs to be able to leverage the amount of capital they can raise under Title III to qualify for So it's almost like a 2-for-1. Math is not that quite that simple, but certainly from a community banker's perspective, if there were more businesses out there having a vehicle through which they could raise the equity to be bankable, more banks would be in a position to say yes. So we would be able to get a leverage effect of the capital that is available in this country to propel innovation and job creation. So I would say kudos, keep going with Title III. Let's get this damn thing passed.
Yeah, I actually did a study looking at the economic impact of crowdfunding on job creation and economic growth. And it showed something like 68% of companies that had done crowdfunding in Europe had a secondary funding event within 6 months. So the idea of crowdfunding as an on-ramp to traditional finance, which is sort of, blurring the boundaries between alternative finance and traditional finance. I think to your point, Kim, you're right. It can serve that function. I've also seen companies here in the U.S. that use Kickstarter or Indiegogo and bring in revenue and customers and transaction histories, which have then made them bankable. So there's...
Get the banks to actually come out of the gate and embrace a hybrid model out of the gate. So that if I'm a business owner and I go to my community and I raise $500,000 or $1 million, that I can go to my local community bank and they would be willing to give me a companion loan for $500,000 that they can get qualified for the SBA, Small Business Loan Guarantee Program, or in the state of California, our Small Business Loan Guarantee. So that we don't have to wait for them to really get started, that we can do this in one unanimous or one simultaneous time.
And Kim, what you're really saying, it's a continuum of finance, which is you start with, you could do a Kickstarter thing to proof of concept. It's an online focus group. Then when we talk crowdfunding, if it's not debt and it's really equity, in all likelihood, practically, it's going to be from your community of relationships, accredited or unaccredited. It's not going to go viral in all likelihood. Those are outliers. And so it's going to be people you know, which is going to give the bank confidence to give that next loan. Other people are going to heat map that. And if it's really an opportunity for a broader cross-section of the country's investors, then it'll elevate itself. Otherwise, it'll just stay there.
I think in theory, you make a good point. The challenge with the current environment is about 40% of the financing that takes place within the United States, I'm not going to talk about abroad, but 40% takes place outside of the banking system now. And we'll be talking about shadow banking a little later. Smaller banks, as you well know, banks in the United States, I think 20 years ago there was about 14,000 banks. Now there's only 7,000. Small banks can't compete. Capital requirements, the institution of Dodd-Frank, Basel III, so on and so forth. Small banks are risk averse. They're not willing to lend because it's easier for them not to set aside reserves but put money into treasuries and repos and so on. So I think the banking system is going to have a bit of a challenge. I think your point's well taken. You throw some more equity, maybe it becomes more financeable. But I think the economics of the small bank is in my view, very, very challenged. And we may see it as going the way of dinosaurs before too long. But anyway, let's thank the panel for their insights. And